Hello, everybody. My name is Trenton Crouch. I'm a businessman and a business student at Fresno State, and today I would like to present to you my investment strategy for the course that I'm taking in investment portfolio management. So, first, I'd like to review the holdings in my portfolio. I have 2 ETFs, VOO and QQQ, and I have 5 single stocks. I chose these ETFs because they are very, very low fees and they're very reputable, and they have shown a history of very good growth. And then I've chosen these 5 holdings, single stocks, because they're large, reputable companies that I foresee to grow in the future. I'd also like to scroll up here and just to kind of tap on the investment philosophy that we had when we were creating the strategy, and that would be to completely mitigate losses. We don't want to lose any money that we've worked so hard to earn, but instead we'd like to invest it, hold it in the account, and allow it to earn interest without worrying about losing the principal, and with the goal of retiring early one day. Now, if you notice, 50% of my allocations are going into ETFs. The best way to diversify risk or to mitigate risk is to diversify. And the best way to diversify, in my opinion, is buying ETFs. Whenever I pick out single stocks, I am basically assuming risk, and I have a low tolerance for risk. So here's what I did. First we'll dive into these ETFs and we'll take a look. I wanted to show you that this is the QQQ. In the top 10 holdings of QQQ are some of the single stocks that I chose. Apple is here, Microsoft is here, and Google is here. There's 3 of the 5 single stocks that I chose. Notice they were they're all in tech. Okay, QQQ has a high focus on tech. And you can see that here. Technology is 44% of its assets. I believe tech is going to be a big part of the future. VOO also has Apple, and it has Microsoft, and it has Google. Again, 23.5% tech, but it's a little bit more diversified when it comes to QQQ. This is supposed to track the S&P 500 more, and this is supposed to track the NASDAQ more. And then I also just wanted to show you that other funds, these are the funds that I have in my 401k for retirement. This is the American Funds Growth Fund. In its top 10 holdings, it also has Microsoft and it also has Google. It does not have Apple. And notice the returns. Last year was 54%, the last 3 years 21% average, and the last 5 years 21% average. And this is Fidelity's very reputable company. This is their 500 index fund. They have Apple, they have Microsoft, and they have Google. So when we pick these single stocks, yes, we are assuming risk because we're putting more eggs in one basket, but we can have confidence that these stocks are going to grow. One, because we know Microsoft, we know Google, we know Apple, we use their products, and we know that they're going to grow. Caterpillar and Deere are huge in the industrial sector. They're big in farming, they're big in construction, they're big in forestry. 3 things that we also know aren't going anywhere. So these 5 stocks, single stocks, yes, you're risking, you're allowing for more risk because you're putting all your eggs into one basket, but you're not really, because the best financial managers in the world are putting them as their top holdings. And so then on the other side of that token, you might ask, well, why are you picking some of the same stocks that you've already invested in with the ETFs? And that's because for the same reason, I'm trying to mitigate risk. And if we look at these ETFs, we can see that Apple is it's less than 6%. So call it 5.5% of this ETF, a VOO, and in QQQ it's 11. So you're only getting 5 or 11% of the growth if Apple grows. By investing into them as a single stock as well with this other 50%, you are getting more of that growth. So we have our risk-averse funds. We have these companies that we believe that that are going to grow in the future. So now all we have to do is cost dollar average on Thinkorswim every month. We will come and we will trade those equities. We'll put 50% of our funds into those 2 ETFs, VOO and QQQ, and we will put 50% of those funds into those five equities that we chose. Do that once a month, and in the long run, you will retire early. Now, if we look, I practiced this for 2 months in March and April, I believe, sold my equities in May, but I was, as expected, profitable in every single transaction. Apple, I didn't make a lot of money, but I didn't lose any money, just like my philosophy, just right in line with the philosophy that I created for the strategy. Apple, we made 20 bucks. Cat, we made 45. Deere, we made 100. Google 300, Microsoft 100, QQQ came out 65, and Vanguard came out 120. Now, mind you, those don't sound very impressive, but it was only for 2 months. If you do that 12 months out of the year for 30 years, well, it won't take you 30 years. You're going to retire early. So hope that encourages you guys to start investing. It definitely opened my eyes. So with that, thank you for your time and have a nice rest of your day.